The two files are sitting side by side on your desk. Both borrowers earn $94,000 a year. Both are applying for the same loan amount on the same house in the same zip code. Both have credit scores above 740, clean payment histories, no collections, no derogatory marks. You will approve one of them this morning and send a denial letter to the other, and the one you deny actually made more money last year than the one you approve. You know this because his file shows it. $112,000 in gross receipts, documented and verified, real money that cleared a real bank account in 12 real monthly deposits. But it does not fit the shape the system requires, and the shape is the only thing the system is built to read. Here is how the room that decides whether you get a mortgage actually works, from the desk where the decision gets made. The approved file takes you 40 minutes. His name is on a W-2 from a school district in the same county as the property, $67,000 a year, for 3 consecutive years, the same employer, the same address, the same withholding pattern on every pay stub. You pull his credit, calculate his debt-to-income ratio, enter the figures into the automated underwriting system. The system is called Desktop Underwriter. It is a proprietary platform built and maintained by Fannie Mae, and it runs on Fannie Mae's guidelines whether or not you or your bank wrote them. You are not, in any meaningful sense, the person making this decision. You are the person who enters numbers into the box that returns the decision. Desktop Underwriter processes the file in under 90 seconds and returns a finding of approve and eligible. You print the finding sheet, verify that the documentation in the file matches exactly what you entered, and move the folder to the cleared pile. 40 minutes, start to finish, including the time you spent refilling your coffee. He will close in 3 weeks. He will never know your name. The second file has been sitting on the corner of your desk for 11 days. The borrower runs a graphic design business he has operated for 4 years. Last year, his gross receipts were $112,000. The tax return you are required to use, because the guidelines require a 2-year average of tax return net income for self-employed borrowers, shows net income of $71,000 after the business deductions his accountant filed. Schedule C deductions, $41,000. Home office square footage allocation, vehicle mileage, software subscriptions, computer equipment depreciation, and health insurance premiums. Every single deduction is legal. Every deduction is exactly what his accountant advised him to file. The accountant was doing the accountant's job, which is to minimize the client's tax liability using every legal mechanism the code permits. The accountant did that job correctly. The borrower saved approximately $9,000 in federal and state income tax because of those deductions. He also, by filing them, permanently and legally reduced the income figure the mortgage system is allowed to count from $112,000 to $71,000. You enter $71,000 into Desktop Underwriter. The debt-to-income ratio clears the threshold by a narrow margin. The system returns a finding of refer with caution. It is not an outright denial, which would end the file automatically. It is a referral, which means the decision now sits with a human underwriter, which means it sits with you in a way that the teacher's file never did. You open the bank statements. 12 months of deposits, averaging $9,300 a month, $111,600, flowing into a business checking account over the course of a year. The money is verifiably real. The business is 4 years old and operating. He is not misrepresenting anything. He reported his income accurately to the government, and the government's record of that income is the only document the guidelines allow you to use, and that document says $71,000. It takes you several years at this desk to fully understand what you are looking at, which is not a gap in the borrower's finances, but a permanent structural mismatch between how income is created and how the system is built to recognize it, a mismatch the system was not designed to fix because the system was not designed for him. The reason the guidelines use tax returns rather than bank statements is not an accident or an oversight. and understanding it changes how you read every self-employed file that comes across your desk. Your bank does not plan to hold this loan. Your bank is an originator. It takes the application, collects a loan origination fee, performs the underwriting, funds the loan at closing, and then sells the loan into the secondary mortgage market, typically within 60 to 90 days of the closing date. The buyer in almost every conventional transaction is either Fannie Mae or Freddie Mac. These two government-sponsored enterprises purchase the majority of conforming mortgages originated in the United States and package them into mortgage-backed securities that trade on the bond market. Because your bank sells to Fannie Mae, your bank underwrites to Fannie Mae's guidelines, because those are the only loans Fannie Mae will buy. Fannie Mae's guidelines require tax return income for self-employed borrowers, because tax returns are the most legally defensible income document the system has access to. They have been signed under penalty of perjury. They have been filed with and accepted by the Internal Revenue Service. They are more difficult to fabricate than bank statements, harder to dispute after the fact, and they create a clean, auditable paper trail that survives scrutiny if the loan defaults and regulators need to reconstruct why it was approved. The system is not optimizing for whether this borrower can make his payments. It is optimizing for the integrity of the paper trail that travels with the loan once your bank is no longer the one holding it. There are, in front of you, two ways to write this file. One of them keeps his loan alive. The first way uses his tax return, the document the guidelines demand, and it produces a refer with caution finding that you cannot clear. The second way uses a 12-month bank statement average, the method some lenders apply to portfolio loans they keep on their own books rather than selling into the secondary market. You run that second calculation. It produces a qualifying income of $109,000, a debt-to-income ratio of 31%, and a clean, immediate approval. The same borrower, the same money, the same year. One method approves him in 90 seconds, and the other denies him after 11 days. The difference between the two is not his finances. It is which document the loan's eventual buyer is willing to accept. And your bank does not offer the second product in the amount he needs because your bank does not keep loans. So, you note the bank statement number in the file as an annotation where it sits, correct and irrelevant, having no effect whatsoever on the decision you are required to make. You return to the tax return. You look for add-backs, specific expense categories that the guidelines allow you to add back to the net income figure before calculating the qualifying amount. Depreciation is the most common. You find $4,200 in equipment depreciation on his Schedule C. You add it back, per the guidelines. His qualifying income rises to $75,200. The debt-to-income ratio improves by 2.5 percentage points. Desktop Underwriter still returns, refer with caution. You have exhausted every option the guidelines provide. The file is as strong as the rules allow you to make it, and it is not strong enough under those rules. The decision you are about to write is not actually your bank's decision, and understanding who made it requires going one step further back to the two institutions that stand behind roughly 70% of every mortgage dollar in the country and wrote the rules your bank only follows. You issue the denial. The letter cites insufficient qualifying income under agency guidelines for self-employed borrowers and includes a required disclosure listing alternative documentation loan programs the borrower may wish to explore with other lenders. The letter is factually accurate in every sentence. It is also the end of this file at this institution on this timeline. The teacher closes 3 weeks later. He buys the house at a purchase price that requires him to stretch his budget. His monthly housing payment sits at 41% of his gross monthly income, just under the guideline ceiling. He qualified because every dollar he earned appears on his W-2 exactly as he earned it. He has no deductions because he is a salaried employee, and there is nothing on his return to deduct. And so, the tax code's incentives for business ownership and investment, the same incentives the graphic designer used legally and correctly, simply do not exist for him. he pays more in taxes and qualifies for more mortgage. That is not an irony in the system. That is the system working as it was designed. The graphic designer will be directed toward bank statement loan programs offered by portfolio lenders. The interest rate on the closest comparable product runs 1.6 to 2% above the conforming rate the teacher received. On the same loan amount, that difference produces a monthly payment roughly $420 higher than what the teacher pays. He pays the premium every month for as long as he holds the loan, because the income he legally shielded from taxation is also the income that could not satisfy the paper trail. More files arrive. You process a retired couple whose combined Social Security and pension income is documented on 2 government-issued forms that Desktop Underwriter reads without hesitation: approved and eligible. You process a nurse whose hospital W-2 shows overtime pay that has been consistent for 3 consecutive years, so you can count it: approved and eligible. You process a freelance software developer who has been contracting for 18 months, 1 year short of the 2-year self-employment requirement. You cannot count a single dollar of the income he has been living on for a year and a half, because the guideline requires 2 full years of self-employment history established by tax returns. He will need to wait. He knows the income is there. It is in his bank account. The guideline cannot see it. You get faster. You develop a reliable instinct for the ones that will move quickly and the ones that will sit for 11 days and still produce a denial. You become precise, thorough, and procedurally correct in everything you touch, and the procedure is what determines the outcome, not the underlying financial reality of the person whose name is on the application. This is not a criticism of the procedure. The procedure exists because loans that do not follow it cannot be sold, and loans that cannot be sold cannot be funded, and loans that cannot be funded mean fewer people get mortgages at all. You understand this, and you continue. The graphic designer files an appeal. You are not the one who reads it. The system did not deny him because he had less money. It denied him because his money arrived in a form the paper trail that follows the loan was not built to carry. 3 things you can do if you are self-employed and planning to buy in the next 2 years. Talk to a mortgage broker before you file your next tax return, not after. The deductions you take this year reduce the income the system counts next year, dollar for dollar in many cases. A broker can calculate the exact qualifying income you need and work backward to your accountant before the return is filed. That conversation costs nothing and can change everything. Ask specifically about bank statement loan programs at portfolio lenders before you assume conforming guidelines are your only option. The rate is higher, but if your tax return income is materially lower than your actual deposits, the difference in rate may be far smaller than the cost of losing the property entirely. Get the actual number before you decide. Find out whether the lender you are speaking with sells loans to Fannie Mae or retains them. Most people never ask this question. A portfolio lender has underwriting flexibility that a conforming lender does not. And knowing which one you are talking to changes which products you can access before you have invested weeks in the process. The 2 files are still on the desk. Both borrowers earn $94,000 in the shape the form requires. One of them does. Somewhere, a self-employed borrower is sitting with an accountant reviewing next year's deductions. The accountant is doing the job correctly. Nobody in that room is thinking about the mortgage.